From New York City for our viewers worldwide, I'm Matt Miller alongside Emily Grafeo. Bloomberg Real Yield starts right now. Coming up, sluggish economic data combined with surging energy costs puts pressure on the Fed's dual mandate. Private credit flashes warning signs as more firms limit redemptions. But on the other hand, public credit sees monster bond sales from Amazon driving the second busiest week ever for high grade. We begin with the big issue, how the Iran war affects the global economy.
Just because the president signaled maybe this will be a shorter-term conflict doesn't mean that that's guaranteed.
It doesn't feel like it's over. We're past peak violence.
Wars or conflicts are easy to start, much, much harder to finish.
You're going to feel that pressure of higher oil prices. So there's no escaping that.
If oil stays up this, for 2 or 3 months, and then it bleeds into a broader inflation.
Headline inflation could accelerate by a percentage point as a result of this.
I think it's bearish for bonds.
The Fed is going to be very, very focused on what happens on the inflation side.
The Federal Reserve should just stay on hold here.
The risk is when does this inflation shock translate into a growth scare?
We see a stable labor market that's generating jobs.
You're not seeing the labor supply keep up with the labor demand.
And it does feel a little bit like we're a frog in a pot of boiling water.
The case for rate cuts isn't there. Now there's much more concern about the stagflation risk.
That leads us to our chart of the week. We're looking at how traders are pricing in the next Fed rate cut. This data here is from the warp function on the terminal. Anything past 25 signals a cut. And you can see, and this has been moving around all week, traders now not pricing the next rate cut until next year, 2027. That was a far cry from where we were just a few months ago. And oil and its effect on inflation likely will play a major factor in future Fed bets. Carlyle's Jeff Karoui warns there's no quick fix for high prices.
When oil prices go up, headline inflation goes up, that gets much bigger, and the damage is going to take months to unwind. But I want to bring it to the immediate. There is no policy response that can stop this ascent in crude. None. Get long, buckle your seatbelt, hang on for the ride, and we're going to reprice this thing.
Bloomberg's Mike McKee joins us now to recap this week's data. So, Mike, we got a lot of data today, this week. Is it safe to say that we're back in an era of stagflationary concerns, or should we not go that far
We
yet?
shouldn't go that far yet because most of this, well, all of this data pretty much is before the war. So we don't know exactly what's going to happen, but it gives us an idea of where we are going into it. Today's, one of today's most important numbers was probably the PCE inflation numbers, but these are for January. They do show that core PCE has gone up to 3.1%. That's not good news for the Fed. Spending was kind of restrained during the month, but incomes did go up. Wages and salaries up by 0.5%. So mixed news there on where the economy is and what the growth scare might be. But we do have some data that tell us that the economy is a little weaker going into the coming months than we anticipated. Fourth quarter growth was cut in half, 0.7% from 1.4%. Consumer spending fell to 2% from 2.4%, and business spending fell to 2.2% from 3.7%. Interesting note in the durables report today, military aircraft orders were down by 23.7%. You'd think if you were going into a war, you might have ordered a few more, but maybe that'll turn around going forward. The other number that really mattered today was the University of Michigan's latest consumer sentiment number, because they did pick up some of the first week of the war. And when I talked to Joanne Shu, it doesn't show in the numbers. We did have a bit of a decline in the headline, but basically Joanne Shu, the director of surveys there, said what happened was they got to the survey at the end of February and people were feeling more optimistic about the economy. And then from March 1st until the survey ended March 9th, people were very, very negative. So there's a good chance we're going to see this number be revised down when they get to their final number, and we'll see the inflation numbers move up because people are worried about the idea of higher gas prices. I brought along my chart of the week for real yield because it kind of shows what people are thinking these days is a little mixed, and it is on both sides of the Fed's mandate. This is the yield curve, and you can see the blue line before the war started, the white line after, and it has flattened at the short end as people priced out, as you were mentioning, Emily, the idea of rate cuts in the short run. But in the longer end, it's flattened out, and that's because people are starting to worry about growth going forward. And so there's a mixed feeling in the markets right now, and I could tell you that this is going to go on forever, but we don't know how long the war's going to go on. So we don't know what it actually means, except it's the perception at the moment.
Well, so, you know, the most interesting question is, or the one that no one has an answer to, as you point out, is how long does this go on, right? How long do oil prices, though, the secondary question is, how long do oil prices stay at these levels? Because you would imagine once we declare mission accomplished, or once we have a ceasefire, that prices should subside, but they won't go immediately down to the levels that they were before because we've already closed off so much production, right?
Yeah, and it takes a while to get the production back online, and there are problems trying to do that. Plus, there's a lot of oil floating out there that has to get to where it needs to be, and then you have to have the refineries available to process it, and they'll be overwhelmed by oil arriving there. So it is definitely going to take time. It could take a couple of months before prices start to come down significantly. And I was reading some oil analysts this morning who said it could be a year before we see prices back to where they were at the end of February.
Our thanks to Bloomberg's Mike McKee. Let's get into all of this now with our macro roundtable. Nisha Patel, SMA fixed income portfolio manager at Parametric, and Priya Misra, portfolio manager at JPMorgan Asset Management under the Core Plus Bond ETF. Priya, let's start with you. Help us understand the price action in Treasuries this week. We saw a lot of movement. We now have the 2-year at 3.7. And yet we have traders fleeing the 10-year, the longer end. What do you make of all of this?
So I think the moves have been probably the most dramatic in the rates market. I would say even though US rates have risen a lot, look globally. European rates, UK rates, that's where the moves have been very, very intense. I think there's a couple of things going on. Number one is, I think there is this inflation fear. Now, I would argue a geopolitical-driven oil price spike is a stagflationary shock, not just the inflation, but I think the market's sort of saying the immediate impact will be on headline inflation. There's some risk of inflation expectations getting unanchored. So that's part of the move. The other part of the move is a deleveraging exercise. I mean, people own treasuries to hedge risk assets for margin calls. There were a lot of these sort of relative value trades, swap spreads, basis trades. I think they're being unwound. And that's why the price action now reminds me a little bit of the, the sort of post-Liberation Day price action, which seemed counterintuitive. The fact that rates were rising then, even though we were dealing with a stagflationary shock of tariffs, I think it's somewhat similar now. But it does make it very difficult for central banks. Now, for the Fed, they've already cut rates. They are seeing this low fire labor market. My sense is they're going to be on hold next week, but to the extent that they want to keep inflation expectations low, I don't think they can sound dovish. And so we're going to have to watch the data. They're going to try and buy time. The market's done, I think, a lot of pushing out of rate cuts. I really struggle to see rate hikes here because the consumer, remember, savings rate is dropping. We're still not seeing very high sort of hiring trends. So I have to think this is going to hurt the consumer. They're going to get tax refunds, but it's not clear that's all going to go towards filling up your gas tank. So as the consumer spending starts to slow down, I think Fed rate cuts will come back on the table. We've been thinking about where do we add duration. I think the 10-year at 4.25 or higher starts to add value. So I think, owning a little bit of treasuries, starting to, you never want to catch a falling knife, but I think, when the market's already done a lot of that repricing, positions are cleaner, this might be the time where you start to position for that growth shock that typically follows an inflation shock.
I wanted to ask you about that because you had mentioned deleveraging. I think it was 2-3 weeks ago we were talking about how Treasuries had the best month since February. Traders were piling in on like a safe haven bet. Is that no longer? Are you not adding the 10-year for a safety, for a type of hedge in a portfolio?
So I would still argue that over the medium-term treasuries or duration will be that hedge. But people have PTSD from 2022 when inflation rose. And I would say today is very different from 2021, 22, when inflation was high, not just because of oil. It was high because of commodity prices, wage inflation, service inflation. But to the extent that the Fed's dual mandate is in tension, if service inflation starts to pick up and our starting point is not great, PCE is around 3%, I think there is a concern that the Fed may not be able to respond. And, to your point, I think in Jan and Feb, every time you had these credit cockroaches or credit concerns, Treasuries worked. I think that's why the long position had been building. A lot of that has been unwound. I think if it's a cleaner position and you've got risk on your portfolio, owning a little bit of Treasuries here is actually going to be a longer term hedge. Of course, if oil keeps rising, that's going to hurt. So I wouldn't say load the boat here, but start to add some duration, because longer term it should work if you have credit concerns as well.
I want to bring in Nisha Patel of Parametric. Core PCE, Nisha, is actually more than 3%. It's 3.1%. So we're still well over 50% away from the Fed's target, and they haven't hit their target, it feels like, ever. And at the same time, President Trump tweeted out overnight, where is the Federal Reserve Chairman Jerome "Too Late" Powell today? He should be dropping interest rates immediately, not waiting for the next meeting. So President Trump wants the Fed chair to cut rates into rising inflation as we see an oil shock. Does that, Nisha, make any sense at all to you?
Well, I think on the Fed side, we have to keep in mind, we already had a very divided committee, right? Something that had been pretty rare when we go back the past few years. So we already have a divided committee. We do have external pressures from the president to lower rates. But I think Priya points out many things that are going to create a much higher hurdle for the Fed to actually follow through with this, especially for next week and likely over the coming months. So in that dual mandate, as we always talk about, right, inflation, to your point, has been actually ticking up slightly. And while the oil price concerns and the inflationary impact of that could be transitory, they don't want to make the same mistake again, right, in preemptively cutting, assuming that inflation is coming down. On the labor market side, we've seen some weakness, but likely they're going to want to see more data points here, right? Again, with inflation now taking over as a greater concern, is the recent jobs data more, I would say, noise, or is this a sustained coolness and a weakness that we're seeing in the labor market? So the external pressure is certainly going to be there. And I don't envy the Fed for being in this position, but I think, as we've heard from Chairman Powell, we're going to have them be much more data focused. And I think wanting to see either sustained decline in inflation, which we as of late have not seen, and a lot of these numbers are pre the war, or they're going to have to see sustainable cooling and weakness in the labor market for them to possibly react. So I think a lot of the cuts, if any of them are coming, are likely to be in the back half of this year. But again, as we've seen with recent markets, we've seen the market just really reprice out, reprice back in. I don't anticipate kind of that short-end volatility to go away anytime soon. It's going to be very reactive, I think, to upcoming data, which will finally price in the impact from this recent crisis.
So, but we don't expect them to cut, obviously, into an oil shock and inflation that's already well above their target. But they can't really raise rates either, can they, Priya? I was just looking at, on the Bloomberg, we have this new Ask B function. It's our own large language model, and it tells me that they tried raising rates into the Arab oil embargo in the early 70s, and it really didn't work out well.
When it is a geopolitical driven rise in oil prices, then that is a growth hit as well. And so I think that's why it didn't work then. In 2022, I think they had to hike. Now that was a rise in inflation, but the starting point matters. We were at zero. So I think if the Fed thinks we're slightly restrictive, and that's what I'll be watching really, is the sense of the reaction function next week from Chair Powell. The dot plot, we're going to get a revised set of dots there. Do they still think that rates are a little restrictive? Because then that raises the bar for them to raise rates. Do they think we're accommodative? We were extremely accommodative in 2022, so they had to hike. What do they see now? But I still think, we're seeing the impact. You talked about core PCE being high. We're seeing the impact of tariffs show up. So now is the time when that tariff impact is coming in, which is why we were expecting the rate cuts to happen later in the year as the tariff effect goes away. Now you're going to have the oil effect. So they might want to look through oil, and we'll get a sense of what are they watching. Is it wages? Is it shelter? Is it X shelter service inflation, other measures, inflation expectations. I think it's incredible that longer-term inflation expectations are actually very well anchored.
They're anchored, yeah.
You know, whether you see it in tips or you see it in surveys.
Right. Nisha, just in the last 30 seconds here, what's the portfolio play based off of all of this?
So I think this higher for longer narrative isn't a bad thing for investors. And in fact, we're viewing this as an opportunity. So as we've seen, I would say over the past few years, a bad and poor experience, I would say generally in fixed income for many investors, we're finally seeing the silver lining of this, right? Again, coming off of 2022 low rate environment, we've had to restabilize and normalize into this higher rate environment. In the end, this means that this is a good income opportunity for our clients. So there are certain aspects of the fixed income market that, again, you want to be higher quality bias. We don't see a lot of room in moving down the credit spectrum, but you don't have to, right? The income aspect and the yield carry here, I think, is very opportunistic in certain asset classes. And I think to, the earlier point, bonds are providing a hedge as well. So in the event that we do see a sustainable impact on the oil pricing, that translating to lower consumption spending, this could actually be over time disinflationary if we really see demand side drop off, right? And bonds provide a hedge in that case if the Fed actually has to react possibly more quickly, speed up the timeline in terms of cuts, if that were to occur. So we like adding some duration here. And I think for high tax bracket clients, one market that we're really liking is the municipal bond market, where quality is high, tax equivalent yields are very attractive in the intermediate to long end of the curve.
Nisha, great to get your take. Thank you so much for joining us. Nisha Patel there of Parametric, and Priya Misra of JPMorgan Asset Management. Still ahead, global bonds surrender their year-to-date gains, heading for their worst month since the end of 2024. Our next guest says Treasuries are not the safe havens we thought they were. This is Real Yield. I'm Matt Miller alongside Emily Grafeo. This is Bloomberg Real Yield. Global bonds erasing their year-to-date gains as conflict in the Middle East escalates. Bloomberg's Nir Kaysar is busting the myth of Treasuries as a haven, writing, quote, long-standing assumptions that Treasuries are a lifeline in a bear market have primed investors for disappointment. Nir joins us now live out of London. So, yeah, why is this? I would have thought that Treasuries should be a safe haven. They're, U.S. dollar-priced instruments that have the full faith and credit of the United States government behind them.
Hi, Matt. Yeah, I think that speaks to the conventional wisdom that, Treasury prices and stocks are inversely related. So when things get hot and stocks are under pressure, or risk assets more generally, you should go to Treasuries because they'll go in the other direction. And a lot of people are worried about whether that's true now because we have this Iran war, and that's could put on inflationary pressures that will push up rates. And also, there's the evergreen debt and deficit problems, and people are worried the bond vigilantes are going to step in and do the same thing to rates, which would be problematic, obviously, if you're looking for a safe haven. But, all of that got me thinking, to what extent is it actually true that historically Treasuries have moved inversely to stocks when you most needed it? And I went back and looked at all the bear markets since the 1920s. We have good data going back that far. And I was surprised to see that it actually is not true. More than half the time in bear markets since the 1920s, either Treasuries have declined alongside stocks, or they just haven't put up any meaningful gains to give you a counterweight. So, I think to the extent that that you're looking for Treasuries to bail you out, the truth is it was never reliable, and it probably won't be reliable going forward.
So, Nir, why have Treasuries in your portfolio at all then? What is the use case?
Yeah, I think that's where you have to be strategic about how you think about bonds. So one of the things we also looked at is we looked at the long-term returns from both Treasuries and credit over time. And just to see ultimately, do you get more, in general, the rule in markets that we all rely on, which is generally a good rule, is that the more risk you take, the more return you should expect. However, in the bond market, it doesn't necessarily work that way. What we noticed is that in the with Treasuries, for example, if you were in the short to intermediate term, you maximized your risk-adjusted returns. As you went out further, 10, 15, 20 plus, you got incrementally higher gains, but you also took a lot more risk. You got a lot more volatility. And so the risk-adjusted returns were not as good. We noticed the same thing in the credit markets as well, except that on the credit side, as you extend out into lower quality credit, the returns actually went down. So the way to think about this is, to the extent that you want bonds in your portfolio, and almost everyone does because it stabilizes the portfolio, gives you a source of liquidity, it's totally fine. But I think you can manage a lot of that risk, and particularly the risk that everyone is worried about in this moment, by just keeping your term short to intermediate and keeping your quality high or just below investment grade.
All right, Nir, great to get your take on this. I'd love to talk more about it, so I might call you after the show. Nir Kaysar there of Bloomberg Opinion. You can see his work and the work of the team by typing OPIN-GO on your terminal. Still ahead, our credit roundtable. We'll speak with Danielle Poli, co-portfolio manager within global credit at Oaktree Capital, and Lotfi, Karoui, multi-asset credit strategist at Pimco. His first TV interview since joining that firm. This is Real Yield on Bloomberg.
I'm Isabel Lee. Let's take a look at our midday movers. First up, Brent crude oil, trading over $100 a barrel after one of the most volatile weeks for the oil market on record. Traders are bracing for more whiplash as Iran pledged to keep the Strait of Hormuz effectively shut. This comes as the U.S. Treasury temporarily authorized more Russian oil sales in an effort to tame surging prices. Also, crypto-linked stocks, they're rising alongside Bitcoin. This comes as investors speculate that Bitcoin could be approaching the final phase of its recent sell-off. Since markets open today, Bitcoin is up as much as 5% and Ethereum is up as much as 7%. And finally, we have Adobe. Shares are down as the company's CEO announces resignation after an 18-year tenure. This announcement comes amid skepticism about Adobe's ability to thrive in the AI era. Adobe's CEO will remain in position until a successor has been appointed and will also stay on as board chairman. Those are your midday movers. I'm Isabel Lee.
Still ahead, a moment of interest. Morgan Stanley and Cliffwater join a growing list of firms capping withdrawals from private credit funds. We'll talk about that ahead on Real Yield. I'm Matt Miller alongside Emily Grafeo. This is Bloomberg Real Yield. Now for a moment of interest, a key event that caught our collective eye this week. Morgan Stanley and Cliffwater joining the list of firms capping withdrawals from private credit funds. Earlier this week, I caught up with Hamilton Lane co-founder Eric Hirsch. He thinks more firms will start to push back.
You've seen a couple of people let the caps go over that 5%, and you've seen others completely hold the line. I think you're going to start seeing more and more hold the line. This is frankly in the investor's best interest. These are not vehicles that are meant to be coming in and out of on a daily basis or a monthly basis. They are there as a long-term capital appreciation tool, and trying to get the managers to sort of force liquidate assets, that's not going to be in anyone's favor.
Joining us now, Bloomberg credit reporter Olivia Fishlow has been on the byline for many of these credit stories. We're also joined by Bloomberg senior editor James Crombie here on set. So this has been a real upheaval in a sense, right? Because these are supposed to be semi-liquid, meaning not 14%, but rather 5%, and investors are pushing for more.
Yes, so these funds, they were marketed as semi-liquid vehicles, and for a while that worked really well for investors, right? They returned capital when investors wanted it, but now we're in a time where more investors are wanting their money back than these funds were prepared for, and then I think overall private credit industry was prepared for, so they're starting to cap redemptions, and some investors aren't getting their money back at this time around.
What are the execs saying, Olivia, when you talk to them in your reporting? What I hear a lot is this is always how the fund was supposed to work. Retail just simply doesn't understand that.
I think there is a little bit of that, and to be clear, like that warning is in the fund documents, but I think it is tough for these investors to understand that, you know, if this hadn't happened before, and, you know, some of these managers are actually allowing funds to be returned above 5%, it's hard to be clear what's going on if there's not like a uniform response. So I think the confusion among retail investors is warranted.
James, what's your sense of just what's driving the redemption requests from retail, from other kinds of investors?
Is it only from retail?
It's fear of the unknown. There's a big hole around software loans. A lot of those firms make big loans to software when debt was really cheap 5 years ago. That debt is coming due. Software, as we know, is being replaced by AI. Meanwhile, there's a lot of concerns about fraud. We've had a few of those recently. There's a lot of supply. There's questions around demand. And as the war drags on, all these markets are going to be tested.
It can't be only from retail, though, right? Because if a concern is in order to fund the redemptions, these BDCs are selling off probably their best assets. You don't want to be last in line to withdraw your money.
I mean, there's a sense of some of this feeding on itself in that there is a sell what you can going on in the market. People are selling liquid assets. Some of that's pretty high rated. The problem is to find a buyer for this, because if it's a loan, it's a contract, not a security. So you really have to do the work. You have to look at the data. You have to see all of the disclosure. That takes a long time, and there aren't that many instant buyers for that stuff. And if there are, they'll offer you 60 cents like Boaz Weinstein did at Saba.
Unless, of course, you own an insurance company that you then use to buy these assets. Is anyone finding that kind of workaround?
I think people are definitely focused on the insurance pension area, and they do have high demand for these assets.
And we have seen BDCs sell loans to their own insurance units.
Yes, to where they manage the assets for the insurer. Yeah, so I think there's definitely, we'll see more creative solutions play out as they figure out what to do with these redemptions.
Olivia, you had the big take just earlier this week all about BlackRock capping its fund, the redemptions in its fund. Why was that significant, that such a large player was doing it? Are we now seeing the follow-through that others are following?
Yeah, so I think it was significant because BlackRock was one of the first movers to be like, actually, you know what, we're not going to give out above this cap, and we're going to sort of take a stand and say, listen, this is how the fund is supposed to work. We want to protect our investors, and if people are unhappy, we're just kind of deal with it and protect them in the long term. And I think that sort of, gave cover for other managers to follow suit after that.
James, I do want to follow up on something you had mentioned about how there is still a lot of supply in this market and how that's actually maybe causing some investors to be fearful. Can you help us kind of walk through that line of thinking?
This week, even though markets were pretty tough, we saw the biggest one-day issuance ever in US high grade, which some people think is good. I think it's pretty worrying in that the banks are telling issuers to go as fast as you can. Hyperscalers have trillions of dollars of needs. They need to issue a lot of debt. That's coming at a time when demand is tailing off. Spreads are going to widen out.
Do we see this actually? I mean, I don't know if anyone's taken an historical look at the data, but when you go into crises like we did in 2007, 2008, it seems to me that's when borrowers rush to market to try and get everything they can priced before it's too expensive.
If you look at the consumer sector, that's 20% of the junk bond and loan market. Those consumer companies, discretionary, are going to be very pressured by the rising oil price, gas prices. They may have to draw on revolvers. We're watching out for any sort of rush for liquidity as a result. People need liquidity. Bad times are coming.
Olivia, you have basically a story out every day on this. What's the next big question that you're trying to get answered?
Only one?
In your sometimes it's more than one. What's the next big reporting question for you?
I think you made a really good point. Is what is happening with institutional flows as well, and these funds are public and they are focused on retail, but this noise must also affect institutional fundraising. So I think that we really want to focus on the asset class as a whole and see what do inflows look like here going forward as there's more fears and more pressure.
I was actually surprised that there hasn't been a big headline today, because it seems like over the last few weeks, every day there's a big private credit drama, and it seems like Morgan Stanley kind of was the last of it so far.
Well, we still have more funds to report, so I think we'll definitely see more, but maybe it's a slow Friday.
We also had Michael Hartnett, B of A, today said it's starting to look like 2008. I've now heard, I had a list earlier, obviously Jamie Dimon has said that. We've heard from Jeff Gundlach on his Twitter. He tweeted something like that. Mohamed El-Erian has said that. Lloyd Blankfein said something like that. So all of these titans now are coming out and comparing it to the great financial crisis. Don't you think that's fascinating? That's all happening this last week?
I think there was a real, air of panic around those times. Unfortunately, I'm old enough to remember them. Now we know that there are buyers of this stuff at a certain level. So I think it's more of a repricing, that there are buyers for the dips, that it's not a collapse.
All right, I tend to be more of an alarmist. So it's good to have a voice of reason with me here on set. James Crombie, they are editor, and Olivia Fishlow, who covers private credit for us. Up next, the auction block. As we mentioned, Amazon driving debt sales to the biggest single-day volume on record. This is Bloomberg Real Yield.
We're halfway through the trading session in New York. I'm Isabel Lee. Let's take a look at our midday movers. First up, Brent crude oil trading above $100 a barrel after one of the most volatile weeks on record for the oil market. Traders are bracing for more whiplash as Iran pledged to keep the Strait of Hormuz effectively shut. This comes as the U.S. Treasury temporarily authorized more Russian oil sales in an effort to tame surging prices. Meanwhile, the Meta shares in the red today after the New York Times reported that the company's latest AI model underperformed expectations and that it will be delayed to at least May at the earliest. Analysts say that Meta is likely to narrow their AI products focus or license Alphabet's Gemini model. And let's check on the couple of recent IPOs. First, shares of Once Upon a Farm, Jennifer Garner's snack company, are down after the company projected slowing sales growth for the first year in its first earnings update as a public company. Once Upon a Farm went public in February, raising nearly $200 million in its first IPO. And finally, shares of PayPay. They began trading yesterday and jumped double digits in today's trading. The digital payments company's $880 million IPO is the largest U.S. debut by a Japanese company in 10 years. Those are your midday movers. I'm Isabel Lee.
Time now for the auction block, where we highlight the big credit issuance of the week. We start with U.S. high-grade assets. Amazon raised $37 billion. That sale, along with Salesforce and Honeywell Aerospace, led the second busiest week on record. Tuesday marked the biggest single-day volume on record. Let's dig deeper into Amazon. It actually had two sales this week, one in the U.S. and one in Europe. Amazon raising more than $50 billion with massive order books for both. The U.S. sale was the fourth biggest week ever for IG, while the Euro sale was the biggest ever corporate deal in the currency. And for comparison, let's look at Salesforce's $25 billion deal. Its order book was $36 billion. That's just 1.4 times the size of the sale. That is well below this year's average, which is about 4.1 times the notes offered for sale. And you can't talk credit without mentioning private credit. Blackstone's John Gray does not see a systemic issue building.
I would expect some increase in defaults just because they're at a very low level. I do think the disruption will have an impact. So I think you have to remember that in non-investment grade credit, historically there are 3% defaults. So if the private non-investment grade world's $1.8 trillion, that means $50 billion of credits default. So that's part of the world that exists. But I don't see, for instance, something larger, systemic.
Let's dig into all of this with our credit roundtable. Danielle Poli, co-manager within Global Credit at Oaktree Capital Management, and Lotfi Karoui, multi-asset strategist at Pimco. Let's start with you, Lotfi, and just talk about the fears right now that there is a systemic risk building in private credit. Because you were coming from the banking sector, do you see any concerns right now that the issues in private credit are spilling over into the banking sector?
Great to be here. Well, yeah, it certainly generated a lot of headlines, this analog between today and 2008. Look, it all depends where you draw the line. I think if by 2008 we mean the current issues sort of morphing into a systemic shock and posing a threat to financial stability, I'd be a little bit careful with that. There's a variety of reasons why I think that risk is much lower today than it was in 2008. But the two biggest ones are really, number one, even though there is leverage that is deployed in the private credit industry, but it's nothing compared to the type of structures that we had in the run-up to 2008. And then two, you really don't have a lot of mismatch between assets and liabilities. I mean, we have to keep in mind that the bulk of the capital is locked up, basically in vintage funds. Yes, there's been significant growth of semi-liquid structures, but those are actually illiquid. There are redemption limits. And so the risk of a bank run style dynamic, I think, is much lower today than it was back in '08. Now, are there fundamental issues? Absolutely. You know, software is one of them. You got to remember that we had record fundraising after COVID. Every time you grow an asset class like that, you're prone to imbalances and you see deterioration in underwriting standards. That's going to be dealt with via possibly a new default cycle. So I think you have to sort of distinguish between a systemic risk and cyclical risks.
I mean, Danielle, weigh in on this, because it makes sense to push back on a comparison to 2008, and yet we've heard so many, right? I just listed Jamie Dimon, Lloyd Blankfein, Mohamed El-Arian, Jeff Gundlach, today Michael Hartnett. They're all making this comparison, but private credit is a much smaller universe than all U.S. mortgages, and banks are so de-risked from that point of view, from that perspective, that it doesn't really make a lot of sense. Oil prices are rising for a completely different reason. Like, what do you see in terms of parallels?
My take is that it's cyclical and not systemic, and that we are moving naturally from a rate-driven environment to a credit-driven environment, where strong underwriting and an insistence on risk control is going to be rewarded. As rates are falling, there's going to be more of a focus on the deal structures that were put in place and the actual underlying credit quality of borrowers. You know us well at Oaktree. Our focus is on bottom-up fundamentals. This is a type of environment where we get excited about an expanding opportunity set. We're seeing opportunities in liquid credit, in private credit, diversifying private credit like asset-backed finance, and also opportunistic situational lending. And I can tell you, being with our traders yesterday on the ground, in the trenches, things felt very orderly. Headlines painted a much more chaotic picture than what it felt like on the ground. In fact, we really wanted to step in and buy, but a lot of the prices that were being quoted weren't transactable. And so I think we're a far way off from that '08 period. Again, this being more cyclical instead of systemic, and a belief that cycles are natural and healthy for the market.
Okay, so Danielle, you said that you're excited. Are you taking advantage of the fact that people need to sell credit right now and buying, or are you maybe waiting?
I ask exactly the same question.
All right, well, it's
Either one of us could have asked that. But yeah, I mean, when I see
wait?
Boaz Weinstein step in and offer 60 cents, I'm like, wow, this is getting exciting.
There are opportunities currently to step in, but I think that the bigger opportunities for bigger price movement may be further down the line. We haven't seen significant sell-off in any way. Yesterday, the high-yield bond market was maybe priced down a half a point or a point. Those aren't big moves. And you're also seeing bifurcation in the market. Software may be trading down, but the highest quality part of the market is trading up. And so it's a little bit difficult right now to call a big step-in opportunity. But I'll share with you an anecdote. Last week, Oaktree held its global client conference, which we do every other year here in California. And every conference, Bruce Karsh and I ask the audience a simple question: which credit strategy is most attractive? Our focus was on liquid credit, and usually we get wildly different results. This year, though, the results were very similar. The audience found that high-yield bonds, leveraged loans, CLOs, real estate debt, all were providing attractive opportunities. And it's interesting, right, because we've come out of a couple periods where higher yielding structured credit and private credit have been the areas that have provided some of the best returns. But today it's a much broader opportunity set, and I think it's only going to deepen, and it'll be great for credit investors.
What do you think, Lotfi? What would you have answered to Bruce Karsh and Danielle Poli?
I would agree. I think on the public side, the opportunity set is actually quite attractive. If I take high quality fixed income as an example, you're being paid 5 to 6%. That's a pretty good value proposition, certainly if I compare it to the equity market. The other ingredient that I would add, and this is like a parallel debate that I think has emerged in recent weeks, it's really the value of having a continuous price discovery signal. Part of the reason why you're seeing a lot of pressure on redemptions on the private side is that you know, when you don't have that continuous price discovery process, you just become anxious. You know, it generates uncertainty and it puts pressure on redemptions. You really don't have that on the public side. And I think a lot of investors are now trying to think a little bit harder about how much illiquidity risk they take and how much they are compensated for it. But certainly on the public side, if I look at high quality, yes, there's value.
Well, it doesn't help also when you see a big, otherwise competent firm mark an asset at 97 cents and then a month later at 0.
Yes.
And we've seen that happen so many times.
Yeah, I wonder what you make of just the relative calm in public credit spreads. Is there some type of trigger that would maybe move spreads to widen, especially in high yield?
Well, I mean, the obvious trigger is always a deterioration in the cyclical outlook. That's something we'll keep an eye on. You know, it's funny, when you go back to where we started the year, I think everyone's baseline was relatively constructive, easier monetary policy, easier fiscal policy. You know, the drag from tariffs was kind of behind us. The focus was really on two sources of risks. One was the labor market and the other one was AI. Now you fast forward almost one quarter into the year, and that risk distribution has gotten a lot more complicated. Yet, if you look at how much risk you've repriced, it's actually fairly modest. And I kind of agree with Danielle. You know, indices have held up quite well. Underneath the surface, you've had significant rotation. So to me, the opportunity set is really at the micro level, more so in terms of sort of trading relative value across indices.
Danielle, when you look at these loan portfolios, how big are the discounts that you're seeing right now?
I mean, the discounts are sizable for software and some of the professional service firms where AI has the potential in the future to disrupt those business models. We certainly haven't seen the impact yet on cash flows. And for some of these opportunities, it's an opportunity to hold or buy more because not all things will be displaced by AI. But truthfully, the highest quality part of the market that we've been speaking about has not seen a lot of price movement. It's trading at historically tight spreads. It's very hard to replicate the average of the industry's indices today, just given the bifurcation. And so what you do need is a focus on credit selection, picking individual securities, focusing on highest conviction ideas, and then pairing that, I think, within a multi-asset construct where you can then shift towards relative value as the market moves, because things are moving relatively quickly, especially on the geopolitical front. And so today things may be calm. Tomorrow things could get a little bit more choppy, and we may want to step in a little more aggressively.
By the way, do you think, Danielle, the other day there was a Goldman Sachs executive who made a comment about how psyched private credit markets were that there's a war going on because otherwise we'd be paying a lot more attention to that disaster. I think I'm paraphrasing him a little bit liberally, but do you think that spreads would be this tight were it not for war? Why aren't we seeing more dislocations because of this?
Yeah, I mean, first and foremost, my thoughts are with our clients and partners and colleagues in the Middle East and hoping that things are resolved quickly. On the ground, it's having less of an impact on our markets because I think everyone has gotten used to just the sheer amount of geopolitical noise. And it's more about distinguishing the signal from the noise. And I think the signal is that long-term investors, real money, are here on the sidelines, are stepping in to buy assets at discounted prices amid volatility. And a lot of the borrowers that we're investing in are high quality. They've used this environment to their advantage to refinance at lower rates. Their balance sheets are pretty stable. Right. I mean, the high yield bond market today is over 50% double B. It's not the junk bond market that it used to be. So there are pockets to hide out and express a more conservative view. And I think just because of that wide opportunity set, we're not seeing the markets get as rattled as maybe they would under other circumstances.
Danielle, we got to cut you off there, but I really appreciate you joining us. Danielle Poli there of Oaktree Capital Management, Lotfi Karoui of Pimco. Great to have you on set. Thanks for joining us. Hope we can get you back more often. This is Bloomberg Real Yield.